Hello, everyone. My name is Logan Jones. I'm with Everhart Advisors, and today I'm going to be going through some principles surrounding the topic of market volatility. Obviously earlier in the year was pretty traumatic with the coronavirus shutdown and the subsequent stock market crash and the recovery. It's been an up and down year, to say the least. And so today I just want to talk about, what are the implications for the crash with regards to your investments and your retirement plan and preparing for retirement. Should you still be investing in your 401k, or should you just put things on hold for the time being? What are just some best practices when crazy things are happening in the market? So that's the topic for today. And, when the market goes down dramatically, it can spark all sorts of questions. Some of the popular ones are, should I move to cash? If investments are going down, you might as well abandon ship, right? Move everything to cash. How do I pull money out of the market? Should I change how I'm invested to something less risky? Should I put more into my retirement savings plan? That would be kind of the opposite approach of the first three. But all sorts of questions will come into play when the market goes down significantly, like it did earlier in the year. And so how should you respond? Okay. Well, today there's three main points I want to cover. I want to talk about the history of market drops and what you can expect moving forward based on what we've seen in the past. I want to talk about some common investor mistakes when the market goes down and just how that can have damaging effects to your ability to retire and your 401k balances. And then ultimately, what can you do? If number two was avoiding certain things, step three would be, well, what are the things you should pursue and how can you prepare for future market drops? So that's the agenda for today. Just to start looking at the history of market drops. I mean, we've obviously seen the market go up and down in the past, and there's been very traumatic events that have happened in the past. I mean, you go back to World War II at Pearl Harbor and Cuban Missile Crisis, Kennedy assassination, 9/11, all sorts of things that have happened in the past. And there were big drops that resulted in stock market, big declines. For example, when Lehman Brothers, 2008, 2009, when they collapsed, there was a 40% decline during that time period. So the question that most investors or many investors are asking now is, well, should I continue to invest or just put my money on the sidelines for the time being? Is now still a good time to put money in my 401k since things seem to be very bleak? Well, when you look at these major events that have happened in the past and you look at the subsequent returns, all but one of the events you made money, and actually a substantial amount of money, in the subsequent 12 months to follow. And then 5 years later, you averaged, in many cases in the high teens, if not 20% in the subsequent years to follow, on the average 5 years thereafter, and then the average 10 years thereafter. So, history would suggest that stock markets do rebound from drops. And when they rebound, it's normally a really historically, it tends to be a big run up in the market in the months to come. So the history would suggest that you should continue to invest in your 401k because when the market rebounds, it often rebounds quickly and it rebounds big. As you've seen this year so far, which I'll talk about in a little bit, that there has been a significant recovery thus far in the year. Now, when you look at all the big drops that have happened historically, these are the major stock market drops that we've seen. On average, the drop's about 30%. That's the decline that we see on average. And it takes about 13 months to reach the bottom, typically, peak to trough, and then another 17 months to recover. So if you recall, the coronavirus, the market started to decline middle of February of this year, 2020. And, it was a very quick decline. It was just a little over a month of a decline. And then, we're on the road to recovery now, but are we out of the water? I don't know. Remains to be seen. If you look back, there's been some time periods where it was a 5-month recovery, and you're right back to where you were 5 months later, even in spite of a 20% decline. Other time periods, though, it took 80 months to recover. So we just don't really know when we'll be out of the water. But one thing that all of these drops have in common, they all have a recovery date. Every single major drop in the stock market has recovered to date. And our expectation would be that if we give enough time to the coronavirus, that it would completely recover to the heights that it was on February 19th before the crash. So we have no reason to believe that, we won't recover from this. Could take a little while, but we have every expectation that we will get back to where we were previously and then soar to new heights thereafter. Now, the drop that we experienced this year was about a 34% decline. And, I've heard many people say, well, we've never seen anything like this in the past. And it's true. We had in our lifetime haven't really experienced an event like the coronavirus where a business is shut down and we have to wear masks and social distance and work from home, et cetera. We haven't really seen that in our lifetime. But in terms of economic trauma and financial trauma, I think the stock market's a great barometer of economic trauma and things that are happening in the economy and events worldwide. And so if you're saying, well, have we experienced anything of similar magnitude in terms of economic distress in the past? Well, the answer is absolutely yes, we have. In fact, in 2008, the financial crisis, by all accounts, that was a worse economic event than the coronavirus was this year, if you're just gauging it based on market declines. And also 2001, we experienced 2001, 2002, roughly the same, 1987. So we absolutely have experienced financially traumatic, economically traumatizing events in the past. And again, the recurring theme is that stock market continues to climb, and on average, 3 out of every 4 years, the market goes up, and 1 out of every 4 years, it finishes down. So even in years where the market was down 34%, like it was in 1987, it finished the end of the year up 2%. So all of these red dots are the biggest drops that we experience within the year. They average out to around 14%. And believe it or not, this year, this is as of August 13th, 2020, the S&P 500 is positive year to date, even in spite of a 34% decline in February and March. So again, we just feel confident that even in spite of drops, which are very frequent, that happen all the time, we feel confident that the stock market will continue to climb to new heights in the future. And it's also helpful to look at, just the history of investing. And, you can go back to 1802 and look at, that's kind of the first stock investment that we can find in the Americas, and 1802. And think about what's happened over the last 200 years. And the dollar investment back in 1802 grew to $705,000 today, net of inflation. And that includes, World War I, World War II, includes the Civil War, the Great Depression, 9/11, financial crisis, all sorts of major economic events that have happened in the last 200 years. And at the end of the day, it keeps climbing. And why is that? Fundamentally, why do you expect the stock market to continue to climb and the general economy to progress forward? Well, it's, at the end of the day, it is companies that you are investing in your 401k, and the stock market. That's comprised of companies that have products that they bring to the market, and they find ways to grow their market share. They're innovative. They're resilient at growing collectively over time. And so that's what you're investing in. You're investing in people and their ability to grow their companies over time. And historically, they've proven to do so in spite of great odds. Collectively, they've been able to persevere. So that's why we feel confident that, hey, we may have a setback here. I may have experienced one with the coronavirus and may not be out of the water yet. But when you look at the history of investing, we would expect to continue to climb forward in years to come. Just one quick note on elections, because I know that's been a major topic with the pending election coming up in November. What about election years? And what's the impact on investing in certain years of, with presidential elections? And if you look at every single election year, going back to 1936, if you were to invest $10,000 at the beginning of that election year, how would you have fared 10 years later? Well, all but 2 of those election years, that 10 years later you doubled your money. Every single one of them you made money, and all but 2 you more than doubled your money. So if you were a betting man based on history, even in election years you would expect to make money in the long run. So I just wanted to address that as a data point, because again, you're investing for the long run, and over long time periods you expect to do very well on your diversified 401k investments. Okay, so what are some common pitfalls that we see? So when the market goes down, if that was the history of stock market investing, the declines happen frequently, but over the long run you expect to make money and you expect for the recoveries to take place. What are some pitfalls and mistakes that people make when the market does go down and in these turbulent times that we're experiencing? Well, one is emotional panic selling. People obviously will panic and go to sell their investments. They try to time the market. They say, hey, I can do better than just putting my money in now. I'm going to wait and put it in at a later date. Or they avoid the market altogether. They invest in things without sufficient research and understanding, and then they also just view investing as a one-time task. So these are all sorts of things that people will do, and it's all around the subject of uncertainty. We just don't know what's going to happen in the future, but we think that we might be able to do better if we take some sort of action by either selling or buying or waiting or investing in things that sound good but we don't really understand them. It's all around the subject of uncertainty, and it's really it's resulted in some serious underperformance when investors make some of these emotionally based decisions. It does historically has resulted in underperformance. So if you look at the general market over this 20-year time period, it's averaged about 6%. But the average stock fund investor only fared about 4.25%. So almost 2% of underperformance per year on average for 20 years. And that's really just a result of letting your emotions get in the way. When the market goes up, people are excited and they want to participate in their 401ks. And, much like 2019, I had a great year in 2019. Really the last decade has been great. But people generally want to participate in their 401ks when the market goes up. But then when it goes down, that's when people say, hey, I'm pulling my money out, or I'm not going to put money into my 401k at all. And they decide not to participate. But as I showed you on the previous slides, historically, we've always recovered from big drops in the market. And so when the market does finally recover, it's at that point that people want to participate again in their 401ks. And so what you do here is you buy high and sell low. And again, you don't want to do that. If anything, you want to buy more when the stock market goes down, which I'll talk about in a second. But you just don't want to let your emotions dictate the decisions that you make with regards to your 401k. You just want to make long-term prudent decisions. And again, I'll talk about that here more in a minute. Also, one thing to note, how damaging it can be if you make an emotional decision with your retirement investments. If you invested $10,000 in 1980 and just let it grow all the way to 2018, you'd have about $660,000, which is pretty good for a 40-year time period. Well, if you miss just the best 5 days in the market, you take the 5 best trading days during that 40-year time period, and if you miss out on those days, how does that affect your rate of return? Well, you almost have, $250,000 less by just missing 5 days. If you miss 10 days, you have over $300,000 less, et cetera, et cetera. So you just don't want to be sidelined and miss out on when the market goes up. Sure, if your money is in cash, you won't participate on any of the downside if the market were to go back down, 20 or 30%. But if your money is sidelined, you also miss out on the upside of $10,000 growing to $660,000 over 40 years. So there's not only downside risk, but there's also upside risk where if you have your money parked, you miss out when the market does well. So just keep that in mind, because that's one mistake that we see investors make, and it can have huge consequences in the long run. So what are some things that you can do? If that's kind of, we've seen what the market's done, we've seen some common investor mistakes. What are some things that you can do to prepare not only for the next market drop, but also, to course correct now in the midst of this current pandemic and current economic turmoil? Well, the first thing would be you want to have a strategy based on time horizons, and I'll show you that on the next slide. Invest based on time horizons, not based on short-term movements in the market or your expectations of the future, or even what you hear on the news. You want to invest based on time horizons, because that's historically proven to be the most prudent way to proceed with your retirement investments. You want to understand your investments and be comfortable with them. Again, you don't want to invest in things that you don't understand. Classic example is Bitcoin, and there's a frenzy there, and people have lost a lot of money in Bitcoin. Kind of depends on when you got into it. But if you don't understand what you're investing in, we would encourage you to do your research. Don't just pounce on an opportunity because it sounds good. You need to understand what you're investing in. Diversify. I'll talk to you a little bit about that, but that's where you just don't put all your eggs in one basket. Don't try and time the market, as I talked about briefly previously, and then you want to continue saving even in bad markets. So, having a strategy based on time horizons, in the long run, as I said, stock market, we expect to make money in the long run over long time periods. In the short run, we don't know what the stock market's going to do. Over short time periods, we've seen really poor rates of return. This was in 2008. We've also seen great runs in the market. This was 1954 and everywhere in between. But over longer time periods, when you get out to 10 plus years, you would expect to make money on your stock investments. Even out to 15 and 20 years. The worst 15-year time period, you earned 4%, going back to World War II, which I'm sure is far better than what you're earning on your savings account or a CD right now. So some of you may be saying, well, I don't have 15 years. I'm going to retire next year, and you start spending this money next year. And there's a place for having some conservative investments and having some cash on hand. But you're likely not to spend all of your retirement money in the year that you retire. That generally what you do with a retirement account is you space it out over time and take the money out slowly. You don't spend it all in the first year. You slowly dribble it out over the rest of your life. So some of the money, if as long as you have a life expectancy of more than 10 years from now, some of the money you won't be touching for 10 to 15 years. Certainly if you're younger and you have a long time to go until retirement, yet you definitely have a long time horizon. But even for those that are approaching retirement, a portion of your money you're not going to touch for a long time. And so you should still have a portion of your money invested in stocks. But you can see here the power of compound interest, and $10,000 invested 40 years ago would have grown to roughly $750,000, whereas $10,000 invested 40 years ago in short-term bonds or cash or money markets would have been only resulted in $58,000. So that's the tension here of wanting to have long-term investments. If you have a long time to go, and then you have more conservative investments if you have a shorter time to go until retirement. But you want to invest based on time horizons and when you plan on spending the money. And generally speaking, the longer you have until retirement, the more stock investments you want to have, and then the closer you are to retirement, or the closer you are to the end of your life expectancy, the more conservative you want to go. And this, by the way, is really where Everhart comes into play. If you're not certain where you should be on the risk spectrum of risky investments or conservative, and you're retiring here shortly and you just need to make sure your investments are properly aligned, that's where we come into play, and we can meet with you individually. Historically, we would do it in person, but obviously for virus reasons, we're limited there. But we're happy to have phone calls or Zoom meetings if you would like to see if you're positioned properly. So, but this is what it means to invest based on time horizons. Now, some people try to time the market, and we would say that that's, it could be a waste of time and also could be potentially disastrous, as I showed you on a few slides back on missing out on the best days of the market. This is an interesting study that was done between 1965 and 1995. If you were to invest $1,000 per year on the best day of the year to invest, namely when the market was the lowest, or on the worst day of the year, or just at the beginning of the year, how would you have fared? If you think about investing $1,000 a year on the best day, you had a crystal ball, you put $1,000 in, how would you have done? Well, perfect timing, you had about an 11.7% rate of return, and worst timing, you had a 10.6% rate of return. So it was only 1% less. And then no timing, you averaged 11%. So, I mean, there's a difference there, but you still are earning great rates of return over that same time period. So it's really, even with a crystal ball, you don't end up that much farther ahead than if you happen to be the absolute worst investor in the history of investing and invest at the worst time every year. So this just shows that it's more important to focus on putting money in, investing based on time horizons. It's more important to do that than it is to try and time the market perfectly and put it in at the exact right time. All right, so that's an interesting point to keep in mind. Next, you also want to diversify. So you don't want to put all your eggs in one basket. And typically, you want to own at least 30 company stocks. And I can say this, that in your 401k, all of the investments in your 401k are properly diversified, meaning you own a bunch of different companies in your 401k if you're investing in your 401k. So you want to remain diversified when you can. You don't want to put all your financial resources in one publicly traded company stock. So you want to branch out a little bit and spread the risk out if you can. Because you see instances of the risks of owning individual stocks. So I've heard a lot of people saying that, hey, I need to go buy this company stock because it was way down in the coronavirus, and there could be a place for that, but you just want to be cognizant that you're not putting all your eggs in one basket. You want to spread out a little bit and diversify. And classic examples, Enron and Lehman Brothers. So that's why it's good to diversify in your 401k and own a bunch of different types of investments. Okay, you want to continue contributing to your 401k even in the midst of big drops in the market. This is an important point that you should try to implement. I heard many folks say, well, there's no use in putting money in my 401k because the market's down and you're just losing money on your 401k investments. Well, your account may be going down in value, but that's really the wrong way to look at it. For those that are accumulating and saving for retirement still, the way you ought to look at it is the same way that you view clearances and sales and Black Friday and Cyber Monday. Why is it that on Black Friday stores are just packed with people? Well, the reason is because there's really great sales going on. You get more bang for your buck. It feels good when you get to buy the same amount of goods and services for a 30% discount. So, you can buy that TV for 30% off. It feels good, right? Well, it's interesting because almost everything that you buy on Black Friday and Cyber Monday, almost all of those things are depreciating assets, meaning you buy them and they decline in value over time. You're not going to be able to sell your TV for more than for more than the amount that you purchased it for, and your clothes lose value as soon as you wear them, and cars that you drive off the lot decline in value over time. So almost everything you consume and buy on sale declines in value over time. Well, the stock market is the only, is not the only, but it is an asset that historically appreciates in value over time, meaning it goes up in value over time. And yet, whenever the stock market's on sale 30%, people don't flock to go buy. They end up selling. They sell the one thing that they can hope to earn money on over time, and then people flock to department stores that are on sale, and they purchase things that go down in value over time. So really, the way you should look at it, when the stock market goes down, everything's on sale. You can buy the same number of shares of Amazon for 30% off, and that's what we saw earlier in the year with a 34% decline. So if anything, you should want to buy more when the stock market goes down, not less. So we would encourage you to continue putting money in your 401k when the stock market goes down, continue to save, and this will bode well for you, for those that are trying to buy, because it's effectively buying on sale. Talking about investing based on time horizons, one solution for you would be the target date funds that we've talked about in the past. The target date fund is meant to always have you invested in something that's appropriate for your age, based on your risk and your time horizon. So you can see here that the blue piece, which would be the risky part, your stock investments, that's the part that goes up and down and fluctuates a ton in value. As time goes by, you still want to own stocks if you can, because that's been a great way to build wealth in the long run. But you do generally want to add more conservative investments like bonds and capital preservation as you get closer to retirement. And the target date fund will do that for you automatically. So if you're planning on retiring at age 65, figure out what year that is. Maybe it's the year 2030, and go into the 2030 target date fund, and that'll do it for you as time goes by, and make those adjustments so that you'll always have an appropriate amount of risk based on your age and time horizon. Okay. And yeah, there's different funds to choose from, ranging from low risk and low return to high risk and high return, and these all have years attached to them, which are again, appropriate for somebody that's going to be retiring in that given year. So that basically covers it for today. The last thing I wanted to say is that, many people focus on the performance of individual funds. They focus on, trying to find the home run stock investments and making sure they time the market perfectly. There's all sorts of things that people focus on, when in reality, the things that have the greatest impact on your ability to retire is not really any of those things. The thing that has the greatest impact on your ability to retire is how much money you're putting into the 401k and how much money you're saving towards retirement, your contribution rate. Because at the end of the day, you can have great timing, great investment choices, but if you're only putting in 1% or barely saving at all, it's not really going to do you a whole lot in the long run. The people that do the best are those that are disciplined at saving, that save a good, healthy percentage of their income towards retirement every year. And even in spite of mediocre investment returns, you can still have a successful retirement if you're just prudent and disciplined at saving towards retirement. So we would recommend continuing your contributions in your 401k. Start if you haven't started. That would be where we would recommend you to focus, and not focus on timing of the market or finding the home run investments, but be disciplined at putting money in the 401k. All right, that about wraps it up. Here's our contact information. If you would like for us to meet with you individually via phone or Zoom, we'd be happy to do that. Feel free to reach out to us here at this number here, or this email. And again, we're here to help you guys. We're happy to meet with you, and this is all, our compensation's included already, so there'll be no cost to meet with us and talk on the phone. Happy to answer your guys' questions, whatever you have. Again, not even specific to this presentation. You can ask questions regarding Social Security and Medicare, et cetera. Everything's fair game there. And yeah, here's some more contact information from us. Other than that, I appreciate the time. Feel free to reach out. Look forward to hopefully seeing you guys face-to-face again one day, hopefully sooner rather than later. But until that time, again, call us if you guys need anything. Thanks for the time. Take care.